10 breadth indicators that you should know. Breadth indicators help in understanding the internal strength of the market. Sometimes you will not be able to understand the direction of the market trend by just looking at the prices of the market alone. Breadth indicators help us understand how the market of stocks is doing instead of just understanding the stock market. Often the breadth indicators signal a market move before it happens through divergences, where the markets are making a new move but many stocks are not participating in that move. In this video, we will discuss the basics of breadth indicators and the 10 most used breadth indicators which traders should know when analyzing the trend move in the market. What are the breadth indicators? Breadth indicators help traders and investors gauge the overall view of the market. The movement in the stock market is examined by using stock indexes. For example, the Nifty 50 Advanced Decline Line is a cumulative guide that helps us in understanding whether more stocks are rising or falling over time. This calculation helps in analyzing the overall investor sentiment in all the stocks within the index. Breadth market indicators are mainly used for two purposes. Market sentiment. These indicators can help us in determining if the ongoing trend of the market is going to reverse. Trend strength. Breadth indicators can also help us in determining the strength of a bullish or bearish trend. Breadth line. Breadth line is also known as the advanced decline line, in which one of the best ways of measuring market internal strength. The line is a cumulative sum of advance minus declines. The formula for the same is shown below. Breadth line value equal number of advancing stocks minus number of declining stocks plus breadth line value of the previous day. When the number of advanced stocks exceeds the number of declined stocks, then the bearish line will rise and vice versa. When the stock market averages is rising but the breadth line is not rising, then the negative divergence occurs, which means that only a few stocks are participating in the move and traders should be cautious when trading in the index. McClellan oscillator. McClellan oscillator is the difference between the two exponential moving average of advance and declines. The two averages are usually 19 days EMA and 30 days EMA. The positive and negative values of this indicator indicate whether more stocks are advancing or declining. The indicators is positive when the 19-day EMA is above the 39-day EMA and negative when the 19-day EMA is below the 39-day EMA. This indicator usually oscillates between the range of plus 100 to plus 500 or minus 100 minus 150. This oscillator can also be used to spot negative and positive divergences. An offshoot of this is the McClellan ratio adjusted oscillator. As McClellan found out the advance and decline line can be influenced by the total number of issues traded, he developed the McClellan ratio adjusted oscillator. McClellan ratio adjusted oscillator is the ratio of net advances minus declines divided by the total number of issues traded. The ratio is multiplied by 100 to make it easier to read. An offshoot of that is the McClellan summation index. This summation index is an area of the McClellan ratio adjusted oscillator. The McClellan summation has multiple interpretations and is considered neutral at a reading of plus 1000. During the 1960s, the McClellan summation index generally stayed within bounds of 0 and plus 2000. The interpretation of this indicator is almost the same as the McClellan ratio adjusted oscillator. Number 3, breadth thrust. Thrust is when the deviation from the norm is significantly larger to be identified and when the deviation signals either the end of an old trend or the beginning of a new trend. One of the breadth indicators of an analysis breadth thrust was developed by Mark Swag, which calculates a 10-day simple moving average of advances divided by the sum of advances and decline. Advanced decline ratio. The advanced decline ratio refers to the number of advancing shares divided by the number of declining shares. The advanced decline ratio can be used for various time frames such as 1 day, 1 week, or 1 month. On a standalone basis, this indicator indicates whether the market is overbought or oversold. ARMS index. ARMS index, also known as the trend and MKDS, is one of the most popular up and low volume indicators. Up volume is the volume traded in all advancing stocks, and down volume is the volume traded in all declining stocks, which is another way of gauging market strength. When a large number of down volume occurs when the market is at or close to the bottom, and when a large amount of up volume occurs when the market is at close to the top. This indicator is calculated advance divided by decline divided by up volume divided by down volume, and it has an inverse relationship with the market prices. Number 6, net new highs and net new lows. Net new 52-week highs is simply breadth indicator, which is calculated by subtracting new lows from new highs. New lows is a number of stocks recording new 52-week lows, and new highs is a number of stocks making new 52-week highs. This indicator provides help in gauging the internal strength or weakness in the market. It indicates there are more new highs when the indicator is positive. On the other hand, there are more new lows when the indicator is negative. High-low logic index. The high-low index compares the stocks that are reaching their 52-week highs with stocks that are hitting their 52-week lows. The high-low index is mainly used by investors and traders for confirming the prevailing market trend of a broad index. Number 7, new high versus new lows. This is the simplest indicator, which suggests buying when the number of new high exceeds the number of new lows on a daily basis. On the other hand, one should sell when the number of new lows exceeds the number of new highs on a daily basis. Number 8, Plurality Index. Plurality Index is calculated as the 25-day sum of the absolute difference between the advances and declines, and is always a positive number. High numbers in the Plurality Index suggest impending bottom, and lower high numbers in the Plurality Index suggest impending top. Number 9, Absolute Breadth Index. This is a breadth indicator which is calculated by taking the absolute difference between the advances and declining stocks. Usually large numbers suggest volatility is increasing, which indicates significant changes in stock prices in the coming weeks. Number 10, TIX Index. This index is calculated by taking all the stocks in the market that have had an up minus all the stocks that had a down tick, and the result is displayed on a chart based on a particular time frame. It is an intraday indicator as it is using data on a tick basis, but is useful for finding inefficiencies in the market. Bottom line, one should note that the breadth indicators can only be calculated on indexes and not a particular stock. Depending on the data available, all these indicators may be calculated to analyze the market strength of the stock market. Traders should use breadth indicators with other forms of technical analysis tools such as chart patterns and technical indicators to maximize the odds of success. You know the catchphrase: study it, analyze it, and adapt it. Peace.